Hey everybody, back with another dividend update, and today we're going to be looking at AT&T finally putting out its dividend cut this week and talking about what the implications of that are and what it's going to mean moving forward. So without further ado, let's get on into it. As we can see reported here from Barron's, AT&T says its annual dividend is expected to be $1.11 a share, which is down 46% from $2.08 a share in 2021. AT&T had been raising their dividend every year for over 25 years, making them a dividend aristocrat, but that sharply ends this week as the next distribution will likely be just over 27 cents. This is a 46% cut. If you all remember from my video back a few months ago when we were actually talking about the dividend cut, I did say it would be about 50%. Analysts were expecting 20 to 30%, so you get better analysis from a stupid YouTube channel than you do from highly paid analysts. Just remember that going forward. Looking at what this means, their total dividends being paid out are going to be about $8 billion, down from about $16 billion previously. So that means they're going to have to generate at least about $16 billion in free cash flow and $16 billion in income to have that 50% payout ratio that we're looking for, or about $12 billion in both of those to have that acceptable payout ratio that we're losing for. Looking forward to some more news, some reasons for the dividend cut, which is very interesting, is we have the CEO saying here, I'd much rather be pouring some cash back into the infrastructure of this business to generate returns at higher levels than what we pay out on the dividend. So it's time to make that transition for the company. If any of you remember, AT&T spent about a decade making acquisitions, quote-unquote reinvesting into the company, which they simply turned around and sold off the vast majority of those acquisitions over the last 2 to 3 years. So when you see something like this statement coming from the same company that did something like that, it's very, very fishy. The only returns that AT&T was able to produce over that time was in terms of their dividends. Otherwise, their stock is flat or down over that period, so just be aware of that. This is a company saying that they want to reinvest into the business when doing so in the past proved disastrous results, and are cutting the only appreciation that they've had in the form of dividends down to less than it was. So just keep that in mind looking forward. Let's look at the financials and see if they're going to be able to support that dividend. We can see here from our free cash flow that in 2020 they did almost $28 billion, so $8 billion in free cash flow should be pretty easy. However, that free cash flow is going to drop with the spinoff, so you're going to have to look at that number and see if you can get at least $16 billion in free cash flow to hit that 50% ideal range. Looking over at the income, we can see kind of the same story here with 20... Actually, we have our 2021 numbers here at $20 billion, which still would be okay with that $8 billion, but again, that income is very likely to drop again with the spinoff. So just be aware, you really need to see those numbers of $16 billion being ideal or more, and $12 billion or more being in the acceptable range. Those are the big numbers you're going to want to look for if you're invested in this. If they are unable to maintain those numbers, if they drop more than that, that dividend is going to be in even more peril. You could see another dividend cut coming up in the future if they aren't able to get to and maintain those numbers. Moving on to some other things about them. What the future might hold, they really need to be... The biggest issue with AT&T is the debt, which is what these spinoffs were done really to address. As we can see, their current balance sheet for 2020 sat at $52 billion versus $63. They're supposed to have already and continuing to aggressively pay down that. Their total liabilities aren't anywhere near as much of an issue, but when a company is underwater currently, they do have to do things like cut the dividend, like sell things off, stuff like that, in order to pay down that debt. If I was invested in this, I would be looking for them to really tackle those debt issues, pay that debt down as much as possible, get back above water, stuff like that. Another thing to look at is the fact that they did lie to their shareholders when they were asked about selling things, stuff like that. This is like just an abusive relationship here. They're lying to you. They're saying they're not going to do something. They're not going to do it again. They continue lying to you, things of that nature. Unless you have really good information about this, unless you really believe in the turnaround for the company, if you're a dividend investor, this is what we would really call this is a dead horse. You are beating a dead horse at this point. Expect more dividend cuts in the future if anything doesn't go exactly to plan, if the debt paying down doesn't go exactly as they expect, if they start acquiring other things that turn out to be lemons. Just expect that dividend to keep going down. As I've said before, if you really want a telecom dividend, Verizon exists. It's better run. It has better financials, stuff of that nature. There are plenty of other 4 to 6% dividends out there that you can get that have wonderful balance sheets, that have much better chance to grow their income, grow their cash flow. AT&T really is a dead horse. If the company didn't exist in 10 years, if it got split up because it wasn't able to do things, that would not be surprising at all. You're going to see a lot of videos out there that are saying, AT&T, this is the bottom. This is when you should buy in. You need to be very careful. A lot of things have to fall into place. If they do reinvest into the business, it has to do well. It can't be like the past decade. They can't acquire things that they then spin off, stuff of that nature. They have to, if they're not going to be growing their dividend, if they're saying they're going to use the money to invest back in the business, they can then use that excuse to cut the dividend further if they want to. Just stuff like that. Be very careful with this. This is a very, very dangerous stock. It's weird to say that about a blue chip, about such a large company, but this company, it's very dangerous with the way that they've acted in the past, what they're saying going forward, the actions that they have taken. If you are invested in this is something where it's okay to check it every day. You shouldn't do that with most of your investments. That's a trading thing, but this is definitely a ticker where if I was holding it, I would be checking it every day to see what's happening. I would be checking news around it to see if similar things are going to occur. If you're not invested in it and you're looking at it, again, it's very dangerous. Be very careful. Know what you're doing. Deep dive into it. Look at what they're going to do. Look at their debt restructuring plans. Look at the things that they're looking to acquire, stuff of that nature. Once again, just be very careful with this ticker, this company, and there's other choices out there, but in the end, it's up to you. And as always, thank you for watching, and I will see you next time.